Patients. This is Deanna Bamford with Pensionmark Retirement Group, and I am ready to begin our monthly webinar series titled Asset Allocation and Diversification. This morning, I am completing a series that I started last month on better understanding the investments in your retirement plan. So even if you were not able to attend my meeting last month where I covered some very basics of the assets or the investments that are offered in your plan, I still believe you'll be able to get some valuable information out of this morning's presentation. And as we get started here, I wanted to remind you, if you weren't on the call right at 10 a.m., that this call is being recorded and will be available on our website over the next hopefully in the next few days, so that if you would like to pass the word on to coworkers or employees that might benefit from this, please do so. We're hoping that this is just another way for you to educate yourself and your employees on your retirement plan and the investment options offered within. So with that said, let's go ahead and get started. For the next 30 to 45 minutes here, I will be presenting, and all of your phones are on mute, so unfortunately I'm not able to take questions verbally, but you should be able to submit your questions via the chat box on your screen, and I will be commenting and addressing questions at the end of the presentation. So please do submit questions if you have them as they come up, and if I'm not able to get to them, or if you're not able to type them in, then please do send us an email directly to Pensionmark, or call us, and I will have that contact information on the screen here at the end. Okay, so with that said, let's get started on our asset allocation and diversification presentation. First of all, if this is your first time attending, or if you're not familiar with Pensionmark, we have been around for over 20 years. Based out of Santa Barbara, California. I've been with Pensionmark myself going on 18 years. It's been a pleasure to work with the group, and we appreciate your partnership with us. We are truly committed to assisting you, our clients, our partners, in attaining your retirement goals. And that is our goal, and this is just another way that we hope to help you achieve that. So again, we are here to assist you in any way we can regarding a retirement plan. So please do utilize us as a resource for you. So in today's presentation, again, I'm kind of building on last month's seminar on basic, asset classes. But today, I hope that you come away with a better understanding of what asset allocation is and what diversification is. There is a difference, and we're going to talk about that. And by the end of the meeting, I hope that you'd be able to better understand the risks associated with investing and the different risks with each asset class. And finally, how to put it to practical use. How do you utilize this information in your plan with your investments to better benefit your retirement needs? That's the goal here. There's 4 parts to our meeting today. First, we're going to talk about, in general, what asset allocation is and why it's so important. Next, we're going to take it a step further and really talk about diversification, and that is going more into really dividing it down not only by asset class, but by different types of assets. So we're going to talk about that, and then we're really going to get into, in your plan, what are your investment options, and how can you put these terms to use, and then knowing when it's time to take a look at your portfolio and possibly make adjustments. We're going to give you some topics and life type changes where it might be time for you to take a look at what you have and possibly changes. So starting off with why asset allocation is so important, and you're going to hear this from me over and over again this morning, and then that's a good thing. We truly believe that this is the key to successful investing. Basically, asset allocation is the process of deciding how much money you are going to invest in each of the main asset classes. And we'll review those in a moment. I spent a lot of time last month on talking about the different asset classes, the 3 main ones being stocks, bonds, and cash. And what determines how much you contribute or invest in each one of those asset classes is going to be based on your current age, your time horizon between now and retirement, and your comfort level with risk. Everybody's got a different tolerance for what you can take in this marketplace and the fluctuations, and we're going to talk about that as well. So those are all factors in determining your asset allocation. And we're also going to touch on the tools that are available with your provider. I've got a group of listeners here, which I so appreciate, but you're all coming from different companies with different fund options. But every one of you most likely has a website that you can visit from your provider where there's some excellent tools. And if you're not sure what those are or how to use them, that's what we're there for, Pensionmark. We'd love to talk to you and get you the information you need and help you get on those websites and use those tools. Asset allocation has actually been proven to account for about 90% of your results. What that means is your actual returns in your 401k plan or your retirement plan are based on how you have spread your money out amongst the different asset classes available to you in your plan. It is not this little small piece of the pie, 10%, which is what we consider stock picking. So if knowing this, it should take a little bit of the pressure off. Hopefully by the end of this session you do understand what asset allocation means and know that that's where you need to concentrate your time and energy. It is our job at Pensionmark to make sure that the investments that are being offered, the different mutual fund options in your plan, are meeting standards, well above standards, are appropriate investments to have in your plan. Your job is then to decide how much of your money should go into each of the different asset classes. So again, it is essential that that's where you spend your time and allow us to help you in that. There are two key terms that we need to understand and differentiate. First is the asset allocation, which I've mentioned, and that again is the percentage of your total assets in stocks, bonds, or short-term cash type investments. So that's how much you have in each one of those buckets or asset classes. Diversification takes it to another level, and that's how much you invest in different types of stocks, bonds, and cash. And again, last month, and I'll briefly review this morning, we talked about there's different types of stocks. There's large companies, small company, mid-sized companies. There's growth and there's value. And in bonds, we talked about investment grade versus high yield and different lengths of bonds, or short-term and medium-term and long-term bonds, and the different risks associated with those. So again, two key terms, not to be confused, and sometimes we use them, interchange them, but they are different, asset allocation versus diversification. And again, here is a nice little arrow here you should see on your screen to your right that kind of gives you the risk in order of these three main asset classes, again, stocks, bonds, and cash. And stocks is going to be towards the top of the arrow, so again, higher risk, but also with that is return potential. So there's different risk characteristics with each of these asset classes. And the higher the risk, historically, the higher the potential for return has been. So again, you've got your stocks at the top, you've got your bonds in the middle somewhere, and then you've got your cash at the bottom. Lowest risk, historically lowest returns. And we're going to take a look at some specific examples of what that means in dollars to you long term, at least looking in the past. Unfortunately, again, we cannot look in the future. So now let's go into more the importance of diversification. And the reasons you need to consider diversification is that is, again, going to be the key to your success. It's going to help you take advantage of the good times in the market, our recovery periods, our bull markets, and it's hopefully going to help protect you against the downturns. And again, there's no guarantee. You could be the most well-diversified investor and have your money split amongst every asset class, every sub-asset class, and still you probably suffered a loss in 2008. You were not alone. Diversification did not avoid losses, but it should have tempered your losses significantly, as opposed to having all your money invested in one particular asset class or sub-asset class. So the two main reasons is, again, you try to take advantage, get the good parts of the up markets, and protect yourself against the down markets. Now this chart you may have seen before. We tend to use this quite a bit in presentations. I love this chart. Here we're going to really take a look at, over the last 10 years, returns by asset class year over year. So at the top, you see it starts with, on the far left, the year 2000, and we go all the way year to date 2010. So it's showing 1 year at a time the best performing asset class in the market at the top, and then the worst at the bottom with their annual return. And even without having the time to, to explain what each one of these asset classes are, some of them are going to be obvious to you. Your real estate and your S&P 500s, and you've got your internationals, and probably, or most likely, all of these asset classes are offered in your plan. But what I want to show you is, if you take a look at the kind of the white box you see through the middle of your screen, and the dots are connected there, that says asset allocation. And so that's had you year over year just had a well-blended, had an equal amount of money in each one of those asset classes. That would have been your return year over year. And you notice if you had a nice mix, a nice asset class, you were never at the very top performer, but you were never at the bottom either. And so in the good years, you had good returns, and in the down years, yes, sometimes there were still losses, but not as much had you been invested, 100% in one of the more aggressive funds. So I like looking at this chart, just looking at the unpredictability of the market, almost the randomness it appears at times. You do not want to be a return chaser. You'll see just by looking at the colors, what was at the top 1 year often is at the bottom the following year. And there's just no way of predicting that. And by using an asset allocation strategy, you can maintain somewhere in the middle, again, and that's usually our goal. We want to preserve what we've saved, but we also want our money to earn for us. So this is one way, this chart, of looking at how that works. Another way of looking at your return potential in the three different main asset classes is in this graph here, which you see on your screen now. And we're going to look at the growth of $100 invested 50 years ago, back in 1961, in each of the three main asset classes, and compare that to just inflation. So this is, if you had invested $100 back in 1961, in 2010, what it would be worth. So had you been invested that $100 in the stock market, and here we're talking about the S&P 500, so we're talking about U.S. stock market, your $100 would have grown to $10,459. Had you invested it in bonds, you would have ended up with $2,981. Short-term or cash-type investments. And in your plan, most likely you have one or possibly two funds, a money market, cash-type fund, maybe a stable value-type fund that would qualify as that short-term investment. The $100 would have grown to $1,300. And then inflation, what you would have needed to have that $100 be worth still $100 in 2010, 50 years later, would have been $735 to buy the same amount you bought with $100 50 years earlier. So you see the long-term direction of stocks historically has been upwards despite the fluctuations. Looking at that mountain-type chart, you see that there's definitely more fluctuations, more peaks and valleys in the stock portfolio, but long-term, the end result was a higher return, which is what you would hope for when you're taking on the additional risk. So again, just a different way of looking how the long-term results of the different asset classes. And again, this is no indication or no prediction of future values, but just looking historically. And then another case for diversification, one other way of looking at how year over year the asset classes, the best performing versus the worst performing, can change. Okay, so in this slide, we're looking at 4 different years, 2005, 2006, 2007, and 2008 in the bottom right-hand corner. And we're looking at solely in the stock market. So again, diversification is taking it a step further and diversifying within the asset class. So right here, we're just looking at stocks over that 4-year period. And you'll see in the lighter blue color is the best performing stock in that year, and then the worst performing is that kind of bright blue color. So you will notice, so back in 2005, your best performer was your mid-cap value stock with a return of 12.7%. And the worst performer was your large cap growth with a return of only 2.9%. Still positive, right? But had you had all your money invested only in large cap growth stocks, you would have ended the year with just under 3% return. And you might have thought, oh, you know, it was positive, it wasn't negative. But if you found out you could have earned 12%, you might not have been, you know, as pleased. And then the following year, take a look at what happened. 2006, your small cap value was the best performing. And again, growth was the worst, but still a positive return. But then look at 2007, the complete flip-flop, reversal. So this is what I want to show you. It's not the numbers that are important here. It's just how the patterns change. The direction changes from the best performing to the worst performing. And you want to be able to take advantage of the good ones and temper your losses on the worst performing style. So that's the key here. So that's what diversification is all about. Next, let's talk about, knowing now hopefully what these different terms mean, how do you determine your proper asset allocation? There's a couple different schools of thought here. And here we have a spectrum again. We like using the spectrum, these arrows. And you can do anything from the do-it-myself, so that's at the top of the spectrum, where you're just going to take a hands-on, active approach in your investment style, down to the bottom of the spectrum, do it for me. So if you're in the other school of thought, hey, this is above and beyond what I have the time or energy or education to do at this time, most likely in your plan you are going to have investments that fall into the do-it-myself, somewhere in the middle, what we call target date funds, which we're going to talk more about in a moment. And some of you may even have the added option of a managed account type service where you can really turn it over to your investment provider. And usually the managed account service has an additional management fee associated with it for a little more active personal management. And again, that may or may not be an option. If you're not sure if you have that option or not, again, please contact Pensionmark and we'll help you find that out. So some steps to consider if you are going to be a do-it-yourselfer, which by all means we encourage, and that is why we offer these types of webinars and educational series. We want to give you the tools. We want to help guide you and again, help you achieve your goals. But some things you want to consider is definitely going to be your time horizon. That's a factor no matter what. When do you need to get at this money? And then the other thing you need to consider is your risk tolerance. And to do that, we have tools. We have questionnaires and online tools, calculators that can help you. You answer some questions and help you determine what your risk tolerance is. And then I'll show you here in a minute on a slide. It'll give you a sample type asset allocation portfolio which you can utilize. So again, if you are the do-it-yourselfer, depending on how many years you have and what your risk tolerance is, that's going to help determine what your mix is going to be. Here are some samples of some different asset allocation mixes. So once, let's say you do complete one of those questionnaires, whether it be online or we can send you a hard copy one, it's going to help you determine what type of an investor you are. And you're either going to fall somewhere on the spectrum of conservative to the far left you see there, balanced, which would be a more moderate, growth, which is going to be somebody obviously a little more aggressive, probably with a longer time horizon, or aggressive growth. And it's interesting sometimes when you take these questionnaires, it's not always your age that determines it. We have many investors that are approaching retirement but tend to be much more aggressive, and vice versa. I've met with many individuals that are young, and we really try to encourage you to be a little bit more aggressive because you have time on your side, but there are some very young investors that tend to be more conservative. So when you're determining a target asset mix, all those factors are going to come into play. And again, if you're the do-it-yourselfer, we want to help you do this. We want to get you the questionnaires to help you determine where you fall, and then you use these target asset mixes, and we can help you to plug in the proper funds in your plan that match each one of those pieces of the pie. So you see there that bright blue, royal blue is your domestic equities. That's, again, U.S. stocks. And if you were conservative, the recommendation in this mix would only be to have 14% of your money invested in domestic U.S. stocks. And so we would find the investment in your plan that invest in U.S. stocks and plug one of those in there, 14%. So again, these are just guides that we have available to you to help you decide where your money should be mixed. And that's, again, if you're going to do it yourself. Now, if you are more the do-it-for-me type investor, if you fall into that train of thought, there are some excellent choices available for you in your plan. You will most likely have some kind of life cycle fund available to you. And in many cases, that's your default. You might be invested in there by default if you were automatically enrolled in your plan. And there's a reason for that. It is, again, it's been proven that this asset allocation and diversification works. And so if an employee, if you're not able to make those decisions on your own or not wanting to, that is why these accounts are in place for you to help you. And how they work is it's basically just a simplified approach to asset allocation investing. It's a professionally managed pool of money where diversification is maintained throughout the investment time period. So that is the nice thing about it. This is your autopilot approach. The do it for me, keep it going, make sure it ages with me as I get closer to retirement. It does all that for you. Let's look at some more examples of how that works. So again, because we have listeners on our line here with different providers, we have to keep this fairly generic, but we can obviously specify this to you if you contact us individually, and we hope that you do. We can assist you with this. But basically, target dates are going to run on a spectrum, and the closer you are to retirement, there's going to be a year associated with them. So you see here down at the bottom of this arrow, we start with a 2005 fund, and then we've got 2010, 2015, and so on. Most likely in your plan, you have target date funds that are incremented at every 5 years. And again, the goal of these funds is to help you invest your money in a way that's appropriate for your time horizon. And even as you get to your projected retirement date, let's say right now you're in that 2015 fund, so you're within years of retiring, you would still have a well-balanced portfolio that has all the different asset classes in it, because the managers are managing your money in a way that you hopefully do not outlive your assets, which means even during retirement ages, some of your money would still be exposed to the higher risk asset classes, just less of it, if that makes sense. So just the allocation would change. What the percentage you have in those higher risk asset classes like stocks would be much less than somebody move over to the right that's in the 2040 fund. So if you were in your 30s right now, you would be in a 2040 type fund or 2045 possibly fund, and your money would be invested in a much larger percentage in those higher risk funds. So as you see, as you move to the right on this spectrum, again, this arrow, there's going to be much more potential for return. But the investment risk is going to be higher. We talked about the two different types of risk again last month. You have inflation risk and investment risk. And as you move to the left, or as you go more conservative with your dollars to preserve more what you've earned, which is necessary at some point, you also are battling the other risk, which is inflation risk. And you need to make sure, again, that not only you do not outlive your money, but that your money is worth enough to continue to maintain your standard of living. So it's a constant balance. But again, the nice thing is that you have this available to you in your plan if you would need some assistance and you want, hands-on professional money manager that's adjusting the fund for you, again, based on a time horizon. Okay, so the funds are still subject to the volatility of the markets. There's no, again, protection completely against loss, but it's using the same concept of diversification, and it's doing it for you. So with that, so either you fall on, I'm going to do it myself, or let them do it for me. There are going to be times when you need to take a look at your allocation and pay attention and reevaluate it. And some of the times you may need to take a look at your allocation and possibly make changes, or usually after a major life change, let's say. So, in addition to the family, potentially a shift in marital status. These would be times that you might need to reevaluate and possibly make a change, or maybe not, but that would definitely be a time when you would want to look at it. Also, your investment time frame changes. Things, happen. Maybe you receive an inheritance or, a windfall or something, and you think you might be able to retire at an earlier date. That might change the way you invest things, or unfortunately, more commonly, it happens the other way, where you realize that you might need to work longer than you had anticipated, especially as they continually extend the age where we can receive Social Security benefits, full benefits, and are reducing the benefits we receive because the money is running out. So most likely what happens is you end up working longer. So which may mean that you're able to potentially be a little bit more aggressive with your money because you've got, again, more time on your side, maybe not. And then after major market changes. Now, I want to explain that because we are not saying that every time there's a major market change or fluctuation, or especially, recession like we just suffered recently, that you need to go make a change to your allocation. But especially if you're a do-it-yourselfer, that may be a time that you need to relook at it. And what I'm referring to is rebalancing your account on possibly an annual basis. So if you are the do-it-for-me mode and you're picking one of the life cycle funds or the managed accounts, then you would not need to worry about this because you've got somebody doing this for you. But if you're a do-it-yourselfer and you've spent the time and you've come up with a good portfolio, with your allocation set, you've got your 40% in U.S. stocks, and you've got your international pool, and you've got it all well diversified, and then we have something that happens like in 2008 and the market declines, well, all of a sudden your allocations are out of whack. In other words, you do not have 40% in U.S. stocks anymore. that portion has probably gone way down because the value of the stocks went way down. And now maybe your 20% of bonds is worth quite a bit more because the bonds maintain their value or continue to go up. Now the problem with that is you're not in the proper asset allocation mix that you had originally selected. So when the market corrects, which we have been here on the last over 2 years now on a recovery mode, recovering from that recession, and some of the first asset classes to come up were the ones that were hit the hardest. If you did not rebalance your account, then you didn't have as much to start with, if that makes sense. So the rebalancing, there should actually be, with all the different providers, wherever your current funds are, there is a feature online, an auto rebalancing feature on the website, where you can have your account on a specified date automatically rebalance back to that mix, like that pie chart I showed you, according if you were on the moderate or aggressive or conservative end of the spectrum, so that it automatically rebalances for you. So again, this is just a feature we want you to be aware of. If you have more questions or need assistance on how to use that, please do contact Pensionmark, because that might be something that you need to take a look at. And then as far as putting this into play again with your specific investment options, let's talk about that. The spectrum of choices that you have, with each one of you having different choices, it's difficult to get too specific again, but for the most part, we have made sure that you have this whole spectrum available to you in your plan. So you need to take a look at your investment spectrum from, again, from over to the left, the least aggressive or less aggressive, to the more aggressive on the right. And here are your different asset classes in that spectrum that are available to you. And I can guarantee that every one of you has these options available in your plan. So on the less aggressive end, you've got your income funds, and those are going to be your bonds. And you probably have a range of different types of bonds available, from high-grade government bond funds to the higher yield, lower-rated, sometimes called junk bond funds. And they have their different risks associated with them. But as a whole, as an asset class, the income funds are going to be less aggressive. And then you've got your asset allocation funds, which we've discussed. Those are your target date funds, or your managed accounts, your life cycle funds, where that's the do-it-for-me approach, where your investments would automatically be spread across the different asset classes and diversified within each asset class as well. And then you've got your domestic equities, your U.S. stock funds. And again, there's a range of those, from large cap to mid cap to small cap, and value versus growth. And if you recall that chart that we looked at with the little boxes, it varies what's going to be the highest performing sector of the stock market alone. So we need to make sure, or you need to be assured, that you do not have all your money just in large cap growth funds, because that might be the best performer one year, but it might be at the bottom the next, and we want to temper your losses and maximize your returns. And again, diversification seems to be the only way to do that. And then to the far right, your most aggressive are going to be usually your international equity funds. And sometimes, in some cases, you might have some specialty funds available as well. And those offer some excellent potential, and there's a great place for those in your plan, but again, additional risks associated with those types of investments as well. So you should have funds available in every one of these spectrums. And again, the burden or the onus is on you to determine how much of your money, where you fall on the spectrum and where you want your money to go. And again, we're here to help you and be a resource for you when determining that. So your next steps, what do you do from here? I hope that this webinar series and this education is a call to action, if nothing more than to just check to see where you currently are and do a quick evaluation as to if that's the appropriate place for you to be. And to do that, your next steps would be to help determine your appropriate mix and compare it to your current mix. So that's another interesting approach, is to maybe, before you even really look at where your currently invested, take one of those questionnaires. Let us send you one, or if you're able to log online and take one, and then compare it to where your current investments are and see how close you are. Maybe you're right on it. Then you can take a look at the different investment options in your plan. And again, it's not so much that you need to research and investigate each one of those funds, because if it is being offered on your menu, most likely it's been put through some pretty rigorous analytics for the fact that it's even on your investment menu. That's our job. Again, at Pensionmark, we really do review and make sure that you have a good lineup available to you. But what you want to do is, okay, do I have the do it for me option? Is that an option for me? So take a look at what your choices are, and then determine whether you're going to do it yourself or do it for me. And if you're going to do it yourself, then we need to plug in the investments offered in your plan to meet your target asset mix. So to fill in those different pieces of the pie with the funds that are available in your plan. And again, there are tools online to do that. You can contact Pensionmark and we can help you do that. And then once you've done that, or if you've done that recently, at least once a year, we recommend that you review and possibly adjust your asset allocation. It may not be necessary to make any changes, but at least once a year, just like you go get your physical and medical, doctor once a year, you do your taxes once a year. Once a year, take a look at your retirement account. Take a look at your different investments, and again, most likely either on your statement or online, it's going to give you one of those pie charts as to where your current money is, and compare that to where you should be. So we really encourage you to use your provider's toll-free number, use the online services, and if you're not sure how to, we can provide you with pamphlets, with instructions. We can get on the line with you and really guide you to it. I believe that you'll feel empowered and more knowledgeable by using those tools. So as far as, again, as I had mentioned, how do you make the changes? In most cases, any type of investment change is going to all be done electronically online. We've pretty much eliminated paper as far as making changes to your investment mix, which is a good thing. I remember the days, I've been around long enough, where you used to submit a form, and it could be weeks before your investment mix was changed. Or hopefully you weren't unlucky enough to have that form misplaced or lost and it never did happen, and that could have serious repercussions in your overall investment strategy. So these days, the nice thing is you are able to log online to your personal account and, if needed, make changes, and they should be effective the very next business day or that same business day if you submit your changes before the close of the market, as mutual funds trade once per business day at the end of the day. So it's very quick. It's nice to know that you have that flexibility. And even if your plan uses paper, and most likely if your plan does use paper change forms, that's more for your contribution amount. So then you would need to contact your HR plan representative to make changes to your contribution, how much is coming out of your paycheck. Okay, so sometimes that's done on paper, sometimes you're able to do that online. Again, if you're not sure, call us. But in most cases, the changes to your allocation is all done electronically, either through the toll-free number of your provider or through the online services. So again, encourage you to use that or to call Pensionmark. And here on my screen now, I've got our Pensionmark contact information. Again, we are here to assist you in any questions you may have. There's our toll-free number, or you can contact us at info@pensionmark.com. We're available. All you have to do is identify your name and what company you're with, and we should be able to access the plan specifics of your plan. So we should know what all your options are and be able to discuss those with you and guide you and help you with whatever we can. So please know that we are here for you to support you, and we appreciate your time and your comments. And next month in our series, I know on a quarterly basis, on a quarterly basis we have our Market Watch. And so I would encourage you, if you would really like to know more about what's going on in the economy and the market and how that affects your plan, to tune into those. Again, we do record our presentations and have them available to you on our website, so if you want to listen to those at a future date or pass those along. And so at this point, I am going to go ahead and open it up to questions. Please type those questions in. I would love to respond to any questions you might have. I do appreciate your time this morning. Let's see if we've got some questions coming in here. I do. Thank you. One, I had a question. Can we view presentations? And yes, we do have last month's presentation recorded on our website, and we will keep those, and you were able to view those, so I hope that is helpful. And we'll continue to send out our evites to future webinars as well. Let's see, as somebody that wasn't able to see a chart I was referring to, if for some reason your screen or you were not able to see something, please, if you can be a little more specific as far as what the topic possibly was, or again, we'll have it recorded for you, or we can email you the slide. So I apologize if maybe I went too quickly through a slide and you weren't able to see it. Send us a specific email to info@pensionmark.com, and we'll make sure we get you a copy of that and further explanation if necessary. So thank you for that comment. I'm sorry if I didn't get to it right when that particular slide was up. Any other questions or comments? Again, it's a lot of information to cover, and we just want you to know that Pensionmark is here for you, and we love to discuss these things. We have an abundance of information and charts and newsletters and things that pretty much anything you can think of that you would like to see to help you have a better perspective of what your choices are and what's happened historically. And again, I apologize, no crystal ball to know what's going to happen in the future, but we do know that the best way to take full advantage of any market conditions, especially during volatile markets like we have seen in the past several years, ups and downs and ups and downs, the best way to kind of protect yourself and set yourself up for success is to make sure that you participate in all the different asset classes and diversify within each one. And again, we've made sure that in your plan that you should have funds, you should have investment options in each one of those subcategories or sub-asset classes so that you can create one of those good portfolios. And once you've done that, again, done the work, it does need to be reevaluated, possibly annually, and rebalanced to make sure you stay in the proper mix to take advantage of the next year's market conditions, because they're not going to be the same as last year's. And you just want to be, again, well positioned in the start to take advantage of those. And again, if you are if you have the life cycle fund, that's doing it for you, but it still doesn't hurt to once a year take a look at how that life cycle fund is invested and make sure it's appropriate for you. So I have another question. Where can we find the asset allocation questionnaires? And great question. Those are usually available online with your provider. So depending if you were with a Fidelity or Putnam or Principal, wherever, DWS, wherever your money may currently be, if you are not able to find it or not able to see it, then contact Pensionmark and we will email you or send you a hard copy of one. I have that question a couple times, so thank you for that. We do want you to use those questionnaires. Okay, and another good question as well. Any reason, in some cases, your target date funds may be in 10-year increments. Some providers originally, when they came out, only offered 10-year increments. In most cases, they've added the 5-year, and if it has not been added to your plan, that is a great question. We'd like to know what plan you're with, and there may be a reason. There may be a very good reason, but we can address that for you as well. Or maybe those are available and you just don't know about them. So good question. I thank you for that, and we can help you find that. Any other questions? I appreciate these, and I know I wish I could just open it up, take you all off mute, and I'm so used to actually talking to you directly and in person, a little different form of media here, but I think it's effective. And again, if nothing else, just to kind of get you thinking and give you a little food for thought, and hopefully, again, as I said, a little call to action to take a look at this, and then it's not something you have to look at every day. Again, we're not saying to try to time the market. We don't want to be day traders. We just want to find a good mix and stick to it, right? Time in the market. So with that, I think I will end our presentation today. Thank you again for your time this morning. I hope you join us for one of our future webinars, and have a fabulous day. Thank you so much.